In this reading, there's a very important and difficult knowledge point here. We need to pay a lot of attention to that. It is talk about the effective capital gain tax and with the blended tax rate. Now, let's see what is that? How do we calculate the effective capital gain tax rate? So I'm going to use example here, so numerical example, so it would help us to understand that at least we can catch up the core spirit of this approach. So let's suppose that you have investment, and the investment current value is $100,000. But remember, this is not a brand new. So you have that for years, and the original cost for this investment is $75,000. Now we expect that this investment, the current value $100,000, is going to grow 10% a year. So in other words, it's going to generate value about $10,000 per year for the next 8 years. So this being the case, I think the investor are willing to know that what is my value after 8 years, and what is the effective return if I have to pay tax, right, over the time. So it's a very interesting and very difficult part here. So we have to pay attention to it. Now, in most of country, all right, the government differentiate the tax rates between income source and the capital gain. So if you look at the income, there's two income sources from the investment. One is the interest income. All right, interest income, like you purchased a, suppose this is a portfolio. So 40% in bond and 60% in stocks. So you're going to generate some interest income from bond, and you're going to have income from equity for stocks as dividends. So these are the income base, and sometimes they are facing, even in the income base, you have different tax rate. Assuming that the interest income tax rates are higher than the dividend income, one is 30%, the other 20%. And another one is a capital gain tax rate is 20%. All right. Now, the point is this. The problem is that the 10% growth of your value is going to have the value contributed from interest income, dividend income, as well as the realized capital gain and unrealized capital gain. Now, the problem is the unrealized capital gain. Using this example, right? The 10% growth is $10,000. Assuming that the interest income is only $300, so that take only about 3%. Okay, 3% of the $10,000 growth or value growth, and then we will have a dividend income $4,000. So that take about 40%. Because $4,000 out of $10,000, that's a 40%. So it's a lot of income growth is from the dividend income. Now here is a 22%. 22% is capital gain, meaning that you're selling some stocks, you get some gain. So we gain about $2,200 is 22%. So if we add this together, 3 plus 40, 43% plus 22, we still have what? It's only 22. This is 43, 65%. So where is the other 35% of the growth, total value of growth? That is from the unrealized capital gain. If you use a 10,000 minus 300 minus 4,000 minus 2,200, so that is equal to 3,500. So 35% of the $10,000 growth contribute from unrealized long-term capital gain. Now, remember, you still have to pay that tax, but you defer the tax to the future. The capital gain tax, assuming it will not change in the future, is still 20%. So, what is the true the tax return, after tax return, for this investment? Okay, so that becomes an issue. Is how do we calculate that? Now, let's do that step by step. Think about that tax. How much you're going to pay tax? The tax you're going to pay this year. You're going to pay 30% of 300 plus 20% of 4,000 plus 20% of 2,200. So you're going to pay 1,330. That is the tax you pay. Now you say, oh, okay, then because I have a $10,000 growth of revenue of value minus the tax, I pay 1,330, and then divided by the 100,000 investment total value to date. So the current value, so it's equal to 8.67%. Okay. Now, of course, you can use the in terms of percentage, same thing. You will get the same result. I'm going to repeat that, but mathematically, it's equivalent 8.6%. Is that the true after-tax return? The answer is no. This is not the true return. Why? Because here all the tax you are paying 1330 it's undervalued because you only pay part of that, 65% of your total growth. There's 35% you haven't paid yet. Right? So 35% is equivalent to $3,500 that you're not paying. You're going to pay in the future, but you still owe government. So we need to consider that $700, which is $3,500 you haven't paid, the unrealized gain, and you're going to pay tax 20% in the future. Say this is $700. We calculate that. So how do we deal with the $700? All right. Now, if you look at this way, if you think about the $700 over the unpaid tax net return, return, you only have, the rate is only about 8.07%. So let me repeat this one. So $700 is the tax on unrealized capital gain. All right, so you're supposed to pay. What is the 8670? The 8670 is equal to the $10,000 minus 1330. Okay, minus 1330. So that means is the after the tax return. All right, in terms of dollar amount. But amount then, you still have $700 that you have to pay as a tax from this $3,500 unpaid, unrealized gain. Do you with me? All right, there's still a $3,500 unrealized gain. You got to pay $700 tax out of the after-tax return, dollar return you're paying already. So that gives you the effective capital gain tax rate for the unrealized long-term capital gain. It's 8.07%. Okay, so sometimes I could ask a question, why is it lower than 20%? Because your base is not based on the total gain or loss. It's based on the gain or loss in the future, and then your base is from the after tax. All right, after tax you already paid now, so that help you to calculate this effective tax rate. Now here say that it is because 65% of return is subject to current tax. Only 35% is subject to the long-term capital gain tax. So it's only 35% of that to pay for the $700. So that's the reason the tax rate is only 8.07%. Now, in the textbook, it gives you this formula. All right, this formula is pretty straightforward. All right, so it's more like the capital gain tax rate, which is like 20% times the 35%, because you only have 35% is unrealized. All right, so only unrealized gain. So it's partial of that, and you divide it by like $700 I calculate, divided by the every dollar you already pay, every dollar you generate after the payment of the tax. Okay, so that calculate you got also 8.07%. It is a little bit difficult to understand, but just read these notes several times, you can understand that. Okay, with the effective long-term effective capital gain rate. So what is the purpose of that? Is that, remember previously we already discussed this 8.67% after-tax return is biased. We need to calculate the true capital gain tax. I'm sorry, the after-tax return. In this reading, we call the accrue equivalent return, which is the true after-tax return. I will show you here. We need to get is 7.76% instead of 8.67%. How do we get that one? Okay, so to do this, we need to first understand what is the true future value after tax. Okay, future value after tax. So think about this. Here is a formulation, all right? Suppose we able to calculate the true future value after tax a year later. We know the base today, all right? Not the base, actually current investment value is $100,000. It's going to actually compound a rate which is implied rate of the return after tax for 8 years. So we actually backward and calculate that return. That return 7.76%. It is the true return of this investment after tax. But to calculate this number, you have to have that future value. All right. In other words, you need to find out what exactly the true future value of this investment associated with different tax rate. So here is a formula here, and actually I don't want really you to memorize it, but I like you to understand that. The future value after tax with blended tax rate and with the unrealized capital gain, we need to adjust that based on this approach. There's a three part. Part 1, 2, 3, and then times the investment value. The investment value here is $100,000, right? So in other words, here is the after-tax effect compounding rate for the $100,000 investment. This calculation will give you the 181,855. So what is that? All right, there's a three component inside the compounding. We call the compounding factor, or future compounding factor. One is the return compounding. We know that the after-tax return right now we calculate before we didn't do the unrealized capital gain tax adjustment is 8.67%. So this is the after-tax return. The first calculation, 8.6%, is going to compound 8 times. But we know this is biased. We need to adjust some kind of capital gain tax we need to pay. So we're going to consider that is to look at the gain of this compounding 1.0867 eighth power minus 1, that will be the compounding, the gain, all right, the unrealized gain in the future, and then times the unrealized gain, capital gain tax rate. So we deduct that, so we will get the more accurate growth factor, all right, for the investment. And this part a little bit difficult to understand is that because we have different cost base, if the cost is the same with investment, say both is $100,000, and this part will be disappear. Okay, but now we know that the cost is $75,000. The value today investment is $100,000. We need to do some adjustment there to adjust the capital gain tax rate. All right, capital gain tax rate, because this is like a return, and then because the base is different, so we need to deduct that fraction of the rate capital gain, because this capital gain from $75,000 to $100,000, that gain you have to pay tax. You have to base on the entire gain to pay the tax. Therefore, there's adjustment here, like 1 minus the 0.75, so that's a 25%. That 25% return, you have to pay the tax for 20% of that. So all this adjustment here, most likely, right? The third part, the third element for the cost-based adjustment, tend to be zero, right? In the examination, I usually will assume this is zero. So the only adjustment is effective capital gain tax rate. So once you do that, you're able to calculate the true after-tax future value, all right, with the consideration of the unrealized capital gain tax, which is you have to pay that anyway, all right? So this calculate, we got 181,855. Now, finally, so use that number. I already calculate the AER, which we call the implied or accrued equivalent return, which is a true return of this $100,000 investment with all this tax. Now, the other thing here is that what is the actual tax rate you are paying? Given, all right, your return is 7.76%, not a 10%. So, which means that you're not going to get 10%. You're going to get 7.76%. So there's a deduction or discount there. That is the cost of the tax, because you got to pay tax. It's a cost. So after the cost, you will have 7.76%. So what is the cost? Before the cost is 10%. So we backward and calculate that. The cost is 22.4%. Not a 20%, not a 30%. Is 22.4%. This one we call the accrued equivalent tax rate, which means it's a true tax rate you are paying with the blended tax rate and include the unrealized capital gain.